Question 21. Compare component cost and composite cost. Answer. The component cost is the one which comes under the cost of capital and it has three levels. Return at zero risk level, which tells about the expected rate of return when there is no risk involved in the project. Premium for business risk. This tells about the variance in operating profit due to change in sales. Premium for financial risk. This tells about the capital structure risk. It is the decision whether to buy components or services from an outsider or not. It requires understanding the cost associated with building and buying the components. Composite capital is also called the weighted average of component cost of common stock, preference shares and debt. In this, each of the components is given an importance on its interest rate. Risk analysis and management loss of control, which is used to compute the composite capital. Question 22. What are the general factors affecting capital structure? Answer. The general factors which are affecting the capital structure are as follows. Company constitution. In companies, capital structure is very important as many companies treat it as a different entity. Private companies considers control factor as important, whereas public company finds cost factor more important. Company characteristics. Characteristic of the company which describe its infrastructure as size, age and credit plays pivotal role in deciding the capital structure. Smaller or newly started companies depend more on equity capital as they can do limited bargaining. Large companies or having good credit companies are in the position to get funds from the source of their choice. Stability of earnings. Fluctuations occurs if the sales and earnings of the company are not stable enough over a period of time. Stable company can take the risk. Attitude of the management. Attitude plays an important role, as if the attitude is conservative then control factor gets the importance, and if it is liberal then cost factor gets important. Question 23. What are the external factors affecting capital structure? Answer. The external factors which are affecting the capital structure are as follows. Economic conditions. If the economy is in state of depression, preference is given to equity form of capital which involves less amount of risk, but it is avoided in some cases where the investor is not ready to take the risk. In this case, company go on with the borrowed capital. Interest rates level. Form of borrowed capital will be delayed if the funds are available in high rates of interest but raising is not favorable. Lending policy. If policy is hard to understand and not flexible, then it is good to go with the borrowed capital. Taxation policy. This policy should be viewed from both the sides, from individual as well as corporate perspective. From the individual point of view, both interest as well as dividend will be taxable in hands of lender. Question 24. What is cost of capital? Answer. It is a process of raising the funds which involves the cost in planning the capital structure. The use of capital should be capable of earning revenue to meet the cost of capital. There are changes in this because of two reasons. Interest rates are less than dividend rates. Interest paid on borrowed capital is unallowable for income tax purposes. Question 25. What is risk factor? Answer. Company raising the capital by borrowed capital, as it accepts the risk in two ways. Company maintains the payment of interest as well as installments of borrowed capital at pre-decided rate and time without being concerned about the profits and losses. Borrowed capital is secured capital in the case where the company fails to meet the contract done with the lenders of the money. Question 26. What is control factor? Answer. These factors have been considered by the private companies while raising additional funds and planning the capital structure. In this, company plans to raise long-term funds by issue the equity and preference shares. It doesn't have relation with the borrowed capital. Question 27. What is risk principle? Answer. Risk principle. This principle deals with the capital structure which should not accept high risk. If company issue large amount of preference shares out of the earnings of the company, then less amount will be left out for equity shareholders as dividend is paid after the preference shares. Question 28. What is cost principle? Answer: cost principle. This principle deals with the ideal capital structure which should minimize cost of financing and maximize the earnings per share. The cheaper form of capital structure is debt capital. Question 29. What is operating leverage? Answer: it is a leverage which refers to the enhancement of profits because there is a fixed operating cost which is involved with each and every component. When the sales increases, fixed cost doesn't increase and it results in higher profits. Higher fixed expenses results in higher operating leverage which leads to higher business risk. Question 30. What is financial leverage? Answer: it is a leverage which refers to high level of profitability because of high fixed financial expenses. It includes interest on loan and preference dividend. Higher financial leverage indicates higher financial risk as well as higher break points. In this kind, the managers have flexibility in choice of capital structure.